This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. It's a tepid start for markets as Fed officials debate further rate hikes ahead of this week's inflation report. Governor Michelle Baumann warns additional increases may be needed. Meanwhile, in Europe, German factories are enduring extended weakness at the Bundesbank, surprises markets with a deposit cap. And wheat jumps as Ukraine's drone attacks on shipping puts Ukraine and Russia's commodity exports at risk. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, it's quiet for now, but it's a big week for U.S. CPI and for U.S. Treasury auctions.
Yeah, we're already seeing a little bit of green on the screen, Dani, which is interesting given how much could change in the bond market over the next few days, to your point. But what's interesting to me is even for the equity market, already seeing elements of breadth throughout that pre-market trade. And it's important to keep in mind as well, when you look at that kind of green on the screen, it is by a slightly higher margin than usual. Futures higher by 0.3%. The Nasdaq's looking about the same, 45.12 on those contracts for our radio audience. But again, I think the bond market is the real story here, Dani, because already a massive move in the two-year yield this morning, almost 8 basis points higher, 483 on the front end of the curve. And a lot of that is coming out of Europe. I'm going to let you explain that to our audience in just a moment. But we'll also have our eye on the FX story. Of course, dollar yen remains in focus. This is the first time in 4 sessions you are seeing yen weakness again. So it has a little bit of a run when it comes to the kind of repercussions of the BOJ and what they're thinking in terms of the inflation front in Japan. But at the moment, dollar yen 142.30, strength in favor of the greenback, higher by about 0.4%. Of course, as we talk about a stronger dollar, the ripple effects are going to be mostly felt in the commodity complex. We're going to dive into this in a little bit, but at the moment, broad swaths of the commodity market down to about 0.3%, Dani.
I got to say, you want me to explain the European picture for bonds? It's not totally clear. There's a lot of cross currents here, so I'll get to that. But first, probably we're starting with European stocks because it's been a really volatile session. I mean, volatile is relative. We haven't seen huge changes, but volatile in the way that we just can't find direction. European stocks opened down, then they went up. We're back down now. Not a lot of earnings to really base anything off of. We've only gotten 2 in the stock 600 today, so that's not really going to move the needle. Perhaps what we're seeing is just a reaction to a negative session on Friday from the U.S. It's kind of hard to shake some of those summer doldrums when a lot of people are away from their desk to really change things up. When it comes to the bond picture, Kriti, you mentioned this. 2-year yields are actually doing something different in Europe. 2-year yields are falling. There is a bid for it. But again, I wonder how much of that is just following on from what we're seeing, what we saw rather in the U.S. session on Friday, or does it have to do with what's happening in Germany with state deposits, again, changing and what's given back with that? We're going to talk to Simon White about it in just a moment. And I just wanted to point out the euro. For all the expectations that the consolidation was over for the euro, it's still weakening, Kriti. It is weaker by about 0.33% versus the dollar.
Well, let's go back to the bond story here, because this is going to be something we talk about for the rest of the week with that CPI number and, of course, the issuance wave that we are expected. In the meantime, Fed Governor Michelle Baumann also saying more hikes may be needed. That comes after Friday's mixed jobs report. The focus now turns, as I was saying, to that inflation print story coming later this week. Take a listen, though, to what Chicago Fed President Austin Goolsbee had to say. Well, it is insignificant when we talk about kind of what the thought process is. Sadly, we have some technical difficulties. We can't get to the SOT at the moment, but we will bring that to you when it's ready. Let's get straight into the analysis here. Bloomberg macro strategist Simon White joins us. Simon, we're dealing with a lot of cross currents in the bond market, like Dani just talked about. She explained the European story, but I want to start with the U.S. one, specifically when we're talking about how you trade an inflation print that could very easily come into contradiction with what we saw in the jobs report on Friday. What do you do here?
Yeah, it's very tricky. I think the market will obviously be alert for higher prints. So the CPI fixing swap market is probably in the shorter term, over the next, say, 3-4 months, probably the best kind of read on what inflation prints are going to be. Basically, there's inflation traders that have to try and figure out what this is going to be. They've got skin in the game. So I think they tend to have a very good handle on what this number is going to be. So 3.3. I think is what's expected for the headline number, and that's not far off where the CPI swaps are. So if it is significantly higher, though, because of what we've seen over the last week or two, that's probably going to be an issue for the market, purely because, as I say, people are now much more alert to inflation risks. And I've talked about this quite a few times before. I think there's a risk that the market's not fully priced of a re-acceleration of inflation. I don't think you're necessarily going to see it, as I say, in the next 2 or 3 months, but further out into the later this year, early next year, I think it's a distinct possibility. I think that's something that's really not been factored in properly by the market yet.
And last week, we did see some significant curve flattening in the U.S. When you look at the German bond market, it's doing the same thing. The front end of the curve, yields are coming in, I was just pointing out before, by about 4 basis points. How much of that is about Friday's trade in the U.S., where we saw that happen with treasuries, versus some of what we heard out of the German government over the weekend on Friday, saying that they're not going to be paying interest on state-held cash anymore?
Yeah, I mean, I think probably the biggest influence is the relief rally after the sort of slightly softer jobs print. I mean, the jobs numbers, I think, is very interesting. 2 things to watch are temporary hours worked and temporary services. Both of these are very good leading indicators of the jobs market. Both of them are continuing to deteriorate. So the market, was already very oversold, and we saw a rally. The German thing, I think, is very interesting, more from a slightly longer term perspective, because it's now going to be more politically contentious. You've basically now got central banks are having to, in a super abundant reserve system, they're having to pay a lot of money to banks because you have all these reserves and you have interest rates that are now well above zero. So this is something that's going to be not just in Europe, but in the US and the UK and other countries too, where they're going to be under much more scrutiny, that they're paying tens of billions of dollars or euros or pounds to banks. So, what Germany's done is something I think that's going to be under the spotlight as we go through this in other countries as well.
Simon, let's stick with the Germany story here and get to the economic data. The industrial heart of Europe now seeing output dropping to a 6-month low. How do you factor that into the story as well?
Yeah, I mean, look, Germany's flirting, it was in recession. Is it out of recession? I mean, the last quarterly GDP print was flat. Maybe that gets revised lower. A lot of the leading data still points to, it's a very fragile German economy. Obviously, the German economy is the most important part of the European economy. Italy is flirting with recession as well. So I think, of course, this factors into the bond yields. But I think in Europe and in the US, it's the same thing. This is not really a garden variety recession. We're having a recession with inflation. And that's not really something that markets have had to deal with. And in that environment, I don't think you can expect bonds to do as well as they would normally do in an inflationary recession. So, you are going to get some sort of rally. I think that's a knee-jerk reaction. But if we have persistent elevated inflation, which we're, seeing several signs of across the, Europe and the US, then I think you have to factor that in. And that means that yields might not behave in the way that you expect them to.
Yeah, more reasons to get caught wrong-footed in this market, as if there haven't been enough of them for the past, 3 years?
Exactly. Get used to it.
Yeah, exactly. We should be used to it by now. Simon White, thank you so much. All right, let's turn to geopolitics in Ukraine. Now, over the weekend, tensions escalated in the Black Sea as Ukrainian sea drones crippled Russian naval vessels and oil tankers. For more, Bloomberg senior reporter for international affairs, Mark Champion, joins us now. Mark, to what degree does this represent an escalation, not just necessarily in intensity, but geographical footprint of this war?
Yeah, that's exactly what it is. We've seen Russia really sort of up the ante in the Black Sea since they pulled out of the international grain deal in July. And since then, they've been hitting Ukrainian ports and infrastructure, the grain infrastructure. And literally what the Ukrainian Defense Ministry said over the weekend was two can play at that game. And that is what is now happening. And the Ukrainians have hit, as you said in the introduction, they hit a naval vessel, and they also have hit an oil tanker. So, given the amount of grain that goes through the Black Sea, virtually all of Russia's grain, whatever, Ukraine can now export, most of it goes through the Black Sea. And then about 15 to 20% of Russian oil plus Kazakh oil. So, we don't know exactly, where this will lead, but it is a significant escalation of the war's footprint.
So break this down a little bit for us in terms of the Ukrainian cities, perhaps in the line of fire here, quite literally, Odessa, Mariupol, et cetera, the significance, Mark, when they come to those grain exports.
Right. So, so on the Ukrainian side, you have the 3 ports that were included around Odessa, and they were included in the grain deal. So they were allowed to operate to a somewhat restricted extent, but they were allowed to operate. The Ukrainians, in the meantime, had been really rapidly expanding the capacity of ports on the Danube River, which were able to kind of circumvent the Russian blockade of the Black Sea ports. So the Russians are now hitting both. They've hit the ports on the Black Sea that were involved in the grain deal, which is now over, and they have also hit the ports such as Izmail and Reni, which are on the Danube, which is, very tough for the Ukrainians. This is an important part of their economy, but it's also tough in terms of, world grain markets, because you're taking grain off the market, destroying silos, etc. On the Russian side, the main port that we're talking about here is Novorossiysk. And that one, that's where the naval vessel was hit, just outside Novorossiysk. The port was briefly closed. You've got about 2.5 million barrels of oil that exit through there and in the Black Sea more generally. So it's an important channel.
It's certainly something we're going to be watching very closely. Bloomberg's Mark Champion walking us through those developments. And as he spoke about oil and wheat, it's worth getting a quick market check on those, because you are seeing wheat higher by about 2.3% this morning. But as Dani reminds me, a 2% swing in either direction is pretty common for that commodity. In the meantime, you are seeing oil pull back a little bit as well. We will keep you apprised of all of those moves at the moment. Right now, we're going to stick with commodities as well. Saudi Aramco joining big oil and boosting its dividends by more than half to over $29 billion, despite a drop in quarterly profit. Bloomberg's Anthony DePaolo, who covers Middle East energy markets, joins us now from Dubai. Anthony, a pleasure to have you on the show. Walk us through these earnings.
Good morning. Yeah, this was a big drop in the profit while they did increase the dividend. And that's kind of following the rest of the industry. We've seen the oil majors coming out through this earnings period, showing us net income down, but the payouts to dividend to shareholders up, either by the dividend or by share buyback. So Saudi Aramco, is continuing in that vein. Really, it was a story of supercharged oil prices last year after that Russian invasion of Ukraine pushed up all commodities. They've come off, and we've seen those down in the first half, which has really hurt the earnings. Add to that the OPEC Plus production cuts that the group has been using to try to stabilize the market, and that means Saudi Aramco has been selling less oil at a lower price, so that's going to hurt the earnings, of course. But this move on the dividend, that's the big news that we're seeing out today. That's going to help underpin some of the Saudi government budgets, which were potentially facing a deficit this year on that first half weakness. That's going to shore up the Saudi coffers, and it's also going to try to help attract some of those investors from some of those majors who are looking for some dividend yield. And the CFO, talking to reporters today, was saying they're getting out of kind of viewing Aramco as a bond rather than a stock, and they're looking at as a growth stock. So they're really working on that dividend, on the one hand, to shore up the government and bring in those investors.
What did you make of Aramco's outlook moving forward, especially with those production cuts in mind?
Yeah, CEO Amin Nasser, again talking to reporters, was saying that he's seeing some positive signs coming out of out of China, which is their major market. He says that there's a lot of room left to go in terms of the recovery there. And that's one of those things that's been a little bit sluggish so far this year, that a lot of producers, a lot of traders have been looking at as the real key to get oil markets back on their feet and back moving more quickly. We haven't seen that in the first half. Now with those cuts that I mentioned before from OPEC Plus, from Saudi Arabia unilaterally, that's brought oil back to where we were pretty much at the end of last year, so wiping out the losses that we saw in the first half. And now we're going to need to see some of that China aspect come in, and that increased demand along with those cuts is supposed to tighten the market in the second half. So we should, if that happens, see some of those oil prices continuing to rise up. Those are the forecasts that we're seeing now.
Okay, Anthony, thank you very much for that roundup of Aramco earnings. Anthony DePaula there with the latest. Now, coming up this hour, we're going to be catching up with Jitesh Kumar, SocGen equity and cross-asset derivatives strategist. Ask why the VIX is just so low despite some of the other volatility. But first, up next, we're going to bring you our exclusive interview with Israeli Prime Minister Benjamin Netanyahu.
I hope that we don't get into a constitutional crisis. I think we won't. I think there's a way of reaching an equitable compromise, which is what I'm trying to do.
Welcome back to Bloomberg Surveillance, the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Israeli Prime Minister Benjamin Netanyahu says that we're about to witness a pivot of history with Saudi Arabia. He spoke exclusively to Bloomberg about the economic potentials for Israel and the potential of working with Saudi Arabia and the Palestinians.
Saudi Arabia, I think, is one of the exceptional things that tells you why I'm very optimistic about Israel. Really one of two reasons, one of two main reasons. One is that, well, I'll start with Saudi Arabia, but then I'll get with the other one. Yeah. I think that we're about to witness a pivot of history. Maybe. I can't guarantee that it'll happen. But first, there's an economic corridor of energy, transport, and communications that naturally goes through our geography. From the Arabian Peninsula, from Asia to the Arabian Peninsula to Europe. We're going to realize that. Yeah. And by the way, my sense is we're going to realize that despite whether we have formal peace or not.
But do you have to give concessions? So we understand Saudi Arabia. So what would you give? Would you limit, for example, Jewish settlements in the West Bank?
Again, you have a good penchant as a good journalist to try to eke out from me my negotiation stance, and of course you're not going to succeed, but you could keep on trying. But do I think it's feasible to have that? And do I think that political questions will block it? I doubt it. If there's political will, there'll be a political way to achieve normalization and a formal peace between Israel and Saudi Arabia.
But, Prime Minister,
that has enormous economic consequences for your investors. And if they have to bet on it right now, I'd bet on it, but I can't guarantee it.
And Prime Minister, this is why I'm not trying to ink out negotiation tactics. I'm trying to understand what you're willing to give, because this is such an important partnership.
Well, I'll tell you what I'm not willing to give. I'm not willing to give anything that will endanger Israel's security. That I will not do. But I think there's enough room to discuss possibilities. I think the Palestinian thing is brought in all the time. It was always brought in. And it's sort of a checkbox, you know. You have to check it to say that you're doing it. Is that what is being said in corridors? Is that what is being said in discrete negotiations?
I don't know. You tell me. What's being said?
The answer is a lot less than you think.
Okay, so if you look at, for example, giving the Palestinians their own state, is that something that you would? Is that a red line?
It won't be their own state. It'll be an Iranian-controlled state that will. In an area that is about the width of the Washington Beltway. If you take Israel and the Palestinian areas in Judea, Samaria, the West Bank together, it's a little more than the width of the Washington Beltway. You put a Palestinian state, which will be controlled by Iran, in half of that, or in the middle of that, you won't have a Palestinian state. You'll have an Iranian terror state. And
so that's a no.
Of course, it's a no, yes.
So that under no circumstances would you allow that?
No, what I said often is that the way that I would have a solution is two things about that. One, that the Palestinians should have all the powers to govern themselves and none of the powers to threaten Israel. This means that in whatever final settlement, peace settlement we have with the Palestinians, Israel remains I would say Israel has the overriding security power in the entire area, ours and theirs. Otherwise, we collapse. They collapse.
The Israeli Prime Minister Benjamin Netanyahu there. Now, coming up, Morgan Stanley's Mike Wilson is bracing for disappointing growth in the U.S. We'll have the sell side latest for you coming up. This is Bloomberg. The This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Now to the sell side, where J.P. Morgan's chief U.S. economist Michael Feroli says that he's no longer expecting a recession in the U.S., which had previously said it expected a recession to begin in 2023. But now the bank sees continued expansion this year and modest subpar growth in 2024 is the most likely scenario. Now, on the other side of things, Morgan Stanley's Mike Wilson says investors should be ready for potential disappointment on economic and earnings growth. Kriti, I kind of get why Mike Wilson is saying this. You can say all you want about his bearish calls not coming to realization, but he calls out the fiscal expansion we've seen. Think about the Inflation Reduction Act, things like that, and said that tightening would reverse that. It would be a risk for the equity market.
And look, he's got a point, and so does Michael Feroli, to be completely frank. When you are starting to see this slowdown in the economy, there is economic data that supports it. The problem is the deceleration just isn't as fast as expected, and this is very normal in an economic cycle. You are going to see a deceleration, but it happens over the span of years, not quarters, as I think we were previously expecting. So the resiliency of Feroli's call makes a lot of sense, but so does the slowdown of Michael Wilson's. Two things can be true, Dani.
Yeah, and we should point out it's not just J.P. Morgan. Last week, Bank of America also capitulated on their recession call. But again, I can't help but wonder how much of this is about fiscal expansion. Now, we're going to hear from the man himself. Mike Wilson from Morgan Stanley joins Bloomberg at 8 a.m. Eastern today. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A tepid start for markets as Fed officials debate further rate hikes ahead of this week's inflation report. Governor Michelle Bowman warns additional increases may be needed. Meanwhile, in Europe, German factories are enduring extended weakness as the Bundesbank surprises markets with a deposit cap. And wheat jumps as Ukraine's drone attacks on shipping puts Russia and Ukraine's commodity exports at risk. I'm Kriti Gupta in New York with Dani Berger in London. Dani, a lot to digest. Geopolitics at play, of course, monetary policy at play. But I think right now everyone might just be in wait-and-see mode for the CPI figures tomorrow.
I thought you were going to say right now everyone might be on the beach, which is probably true, too. And I think that's for the reason here. I mean, I know you and I both wish we were. Just kidding. We'd, of course, want to be here with you, all of you watching at home. Look, for European equities, it does feel like we're just unable to shake off of what happened on Friday. I should say for all of these markets in Europe, we're unable to shake off the Friday markets just because we are in the middle of the summer, the kind of edgy markets where there's no catalyst, at least for today, to really turn things around. We're also really light on the earnings front. We're more than 80% through the earnings season in Europe. So European equities are falling again, like what the U.S. did on Friday. Meanwhile, the euro, we thought that we'd see the end of consolidation. We're not there yet. The euro dropping, weakening versus the dollar, down about 0.33%, perhaps in reaction to Michelle Bowman talking about the need of more rate hikes. And finally, the front end is getting a bid here in Germany. Now, at the back of last week, in the whole of last week, we saw this really extreme steepening in the curve. On Friday, we had the jobs report. You did see a relief rally. And it's likely, again, what we're seeing in Germany, Kriti, is just a catch-up because European markets were mostly closed when that happened. So bid into the front end. Yes, we got some changes on deposit caps for German government holdings, but that's more of a long-term story. So for now, it's kind of, again, the polar opposite of what we're seeing in the U.S. just because we have catch-up to do, Kriti.
Yeah, I was literally just going to say that. You are seeing the exact opposite in the U.S. stateside. Green on the screen, actually, when you look at the equity market here, by, I think, a significant margin for about 5:30 a.m. New York time, up about 0.3% on S&P contracts, 45.13 for our radio audience there. The bond market, though, gets interesting. And actually, before I get to that, I want to mention quickly that the stock market is seeing very broad gains this morning. So that could be a positive as we enter those opening bells. The two-year yield, though, 4.84 is what I'll call it there, higher by about 8 basis points. So already seeing a real sell-off at play in the bond market. You go further out into the curve, you are seeing the same dynamic. Now, ordinarily, you would think that the volatility in Europe might be sleeping in, but a lot of those questions that you had in terms of Michelle Bowman, for example, calling for additional rate hikes, the anticipation of a CPI report tomorrow, it's all going to factor in to the bond market story this morning. Nevertheless, 4.84 on the two-year yield. Of course, we talk about the bond market. We have to talk about the strength in the greenback because specifically against the Japanese yen, you are seeing that 142.25 2024 on that currency pair, stronger by about 0.3%. This is significant because this is the first session after 4 consecutive sessions of strength in the Japanese yen that you are now seeing a little bit of a pullback. So that's going to be a currency pair we're going to keep an eye on. And of course, with that dollar strength, with those higher yields, the ramifications are going to show up in the commodity market, especially as we get those headlines out of Ukraine and Russia. Bloomberg Commodity Index broadly lower, though, down about 0.2%, Dani.
You mentioned volatility throughout that, Kriti. Let's look at what volatility is doing, options-based volatility, because despite the longest losing streak for American equity in about 3 months, despite a day where we saw U.S. stocks fall by more than 1.33%, equity volatility, the VIX specifically, has been very subdued, still below 20 despite a move index, despite bond volatility that has picked up. Well, our next guest has been calling for lower volatility this year. He's nailed that call. Let's bring him in. It's Jitesh Kumar, equity and cross-asset derivative strategist at SocGen. Jitesh, really great to speak with you today. Okay, what would it take to wake up slumbering equity volatility? Is there anything on this horizon that could do it?
Thanks for having me, Dani. Yes, of course. I mean, we can have volatility from various events, but fundamentally speaking, I think U.S. equities and global equities have been in a very good place. The profits have kept up. We are near 50-year highs in profit margins. So the reason why we've been calling for lower volatility is because corporate sector broadly has been doing very well. So we haven't had the reason to have higher volatility because profits in general are negatively correlated with equity volatility. So higher profits automatically mean negative volatility, lower volatility. Now,
right, and Jitesh, if I can jump in here, because that's actually what I wanted to get into. So this is perfect. It's bound to change next year. What's going to change that? Again, especially if we've seen a lot of the positioning being that trade to pick up pennies in front of the steamroller. This is not a market prepared for more volatility.
Yes, I think there are 2 aspects to it. One is the fundamental reasons why volatility goes up, which is the health of the corporate sector, the broad-based economic backdrop. Whereas the second thing we should also look at is the positioning, which changes from time to time. So I think these 2 often interplay with each other. Right now what we have is the health of economy has been good, so that's why vol has been fundamentally going lower. Now what we are seeing is positioning starting to get into lower volatility. So basically people are starting to sell vol. It's already been happening via options. So just to give you an example, right? If you are short vol, one variance swap on the forward space, you have 4 or 5 vol points of pickup at this point, which is the maximum you've had, let's say going back 4 or 5 years. So the conditions are very favorable for the short vol trade, which is why it's likely that we see more inflow into this. But eventually, I think when fundamentals take us in the other direction, things change slowly. It takes time. Now is not the time. We think there is at least another 3-4 months. And till the end of year, I think vol will remain low. That's our base case.
Jitesh, let's move a little bit to the bond market here and really zero in on there, because if we're talking about the wave of issuance we're expecting this week, I think there's a lot of questions in the market about just how much the bond market is going to be able to digest that, especially given we're already seeing about an 8 basis point move higher in the front end of the curve in the U.S. this morning. How does that square with some of kind of the VAR shock risk that you might see play at the market? Square the 2 for us.
Yes, I think that's a very good point. And honestly, VIX has picked up from the low 13s to about 17 right now because of this. So bond market volatility does feed into equity volatility to some extent. But I think the big mistake that investors make is to expect a one-on-one translation from bond market volatility to equity vol, which doesn't happen at all. I'll give you an example. So if you look at the total interest cost of the corporate sector, it has changed by it has actually fallen by 22% since 2021, whereas the sovereign interest that the US government pays has gone up by 76%. So we've had a divergence between what the health of the corporate sector and the health of the US government. So it's no wonder that bond market volatility is going up. Now, you're right that technicals do play a role, and if you have a VAR shock, some people have to mechanically offload positions. But again, if you have a fundamentally favorable backdrop, I don't think that the technicals can override that to a large extent. For example, even in Volmageddon, right, in 2018, when we had this huge flow-based move, I think we didn't really we went back to a VIX of below 15 in June, July. So I think we need both fundamentals and technicals to turn bad for vol to really pick up from here.
I mean, isn't that the dream, though, to have technicals and fundamentals work in the same direction? Jitesh, when it comes down to it, you also have to square in monetary policy. To your point, do you start to see the plumbing take precedence over what, say, Jay Powell might be saying?
Again, I think this is in the volatility space, especially, hedge funds and lots of technical players are basically, they base their flows, their trades on the flows. And I think we need to take a longer term view of things and look at the fundamentals, because if we don't have, as you said, if both fundamentals and technicals don't align, then we don't have the best conditions for trade. So right now, you're right, fundamentals have been great. The thing is, technicals are now pushing vol lower. Very soon, fundamentals will start to move in the other direction. So maybe now people trying to buy vol is still a bit too early in our view. What we are interestingly seeing is lots of people pulling back their recession calls. I think we will have some payback next year because we've had a huge move lower in rates since 2019, since COVID, and now it's been 12 months, 15 months since the Fed has been hiking rates. I think we need more time. There's a very classic example that I give. For example, if you're cooking something in the oven, right, you can either raise the temperature or you can you have to keep the dish in for, let's say, an hour. Now, you can't take the temperature to double the temperature and say, okay, I'll only cook it for half the time. That doesn't work. So monetary policy really does need time to pass through to the whole economy. And I think you cannot really fight that. That's the way it works in the markets.
Jitesh, little did we know, not only were we going to get a great view of the market, but also fantastic cooking advice, too, because I feel like that's a sin I might have committed. Look, we're related to what you were saying in response to Kriti's question about the bond auctions. Part of the reason we've also seen volatility further out on the curve, further out in duration, is because of the unanchoring of the BOJ, or at least the expectation we're going to get some unanchoring in yields. What have you seen in terms of changes in pricing around duration volatility, and what do you expect to come in terms of the BOJ's impact?
Yes, I think that's a good point. So, for example, in 2022, when bond volatility was high, NASDAQ and long duration sectors had the highest volatility, and that fed through because it's a big part of the US equity market. So I think it shows up in volatility. So whatever the BOJ does has a big impact on the margin. And I think what we need to do is be careful of duration risk here, because we may have some more volatility in the long duration sector of the market because of that, because of higher issuance as well. However, I think there are ways to get around that. For example, one trade that we've been recommending is, and our Asia equity strategy team has been quite ahead on this as well, is Japanese banks, which have done really well. And every time you see a rise in the Japanese bond yields, this is a sector which does outperform. So I think it's one of those things where you have to diversify into different kind of assets, not be careful of your duration exposure in this environment as well.
So positive on Japanese banks and positive on the short vol trade. SocGen's Jitesh Kumar joining us on Bloomberg Surveillance Early Edition this morning. We thank you as always. Coming up on the program, shares of Berkshire Hathaway higher in the pre-market as the firm posts strong operating profit backed by its insurance business. We're going to walk you through it. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Shares of Berkshire Hathaway rising in the pre-market after Warren Buffett's conglomerate posted gains in operating profit driven by strength in its insurance business. Shares higher by about 1.5% this morning already. Let's bring in Sonali, Basak, our global finance correspondent, to break us through it. Walk us through the earnings story for Berkshire.
Yeah, for somebody who had warned that things could get rough this year, the earnings are looking actually pretty good, particularly in that insurance business where there have been a lot of questions about competition. Listen, the top line also grew as well as the bottom line because they had a lot of expense control. Our colleague Max Reyes over at Bloomberg points out something interesting here is the policies in force were actually kind of below what you would want there to be at Geico, given that they have reduced expenditures on marketing. However, you are still seeing healthy results over at the insurance company, which is, of course, a massive business at Berkshire. I would also say that despite its very large cash hoard, the market's up. The net unrealized gains here for their investment portfolio are also pretty significant, especially because it's been holding the likes of Apple, which did very well through the first half of the year.
Well, Sonali, as you yourself mentioned, I mean, last time we heard from Buffett in Omaha earlier this year, he was warning about this downturn, especially in the economy. Did we see that play through in any parts of his businesses?
Yeah, we certainly did, and that's the railroads, utilities, energy businesses. If you looked at kind of the comparison side by side next to those insurance businesses across from the railroad businesses here, the costs rose much more dramatically over at those real economy businesses than they did over at the insurance company, where we have been saying that he is cutting costs. So that was one of the big differentiators when you looked at the profitability, but there was also pressure on the top line relative to the insurance companies when you looked at those real economy businesses.
So I want to go back to the cash hoard question in particular, Sonali, because if you look at the S&P 500, Berkshire Hathaway is the 10th largest, call it ninth largest company, top 10 companies in terms of market weight when you look at the S&P 500. If you have a massive cash hoard or even a declining one, that's going to have real market ramifications. Walk us through why that's so significant here.
Yeah, it's an interesting dynamic for Berkshire Hathaway because you're investing in Berkshire, you're investing in all their businesses, but you're also investing in their investment portfolio. And they have a massive amount of treasuries. We had Berkshire and Buffett last week come out and saying that this fiscal downgrade is not a big deal, but he's mostly talking about that short end of the curve. And that dynamic relative to where you're seeing the 30-year go today, I think, is a very interesting question. One other story we have on the terminal today is about hedge funds kind of utilizing the basis trade at a greater scale. And when you're doing that and arbitraging the longer dated securities versus the shorter ones, if there are any hiccups in the future, I think that's kind of the thing I know I have my eye on, I know the banks have their eye on, and would be the one thing that kind of would throw Buffett's kind of thesis out of whack here.
Yes, which is always why when we look at CTFC data, which showed hedge funds at a record short on bonds, we should always remember that basis point trade, Sonali. Look, elsewhere on the terminal, the most read story over the past hour is that UBS will be cutting 2/3 of Credit Suisse bankers in Asia. Sonali, what's this all about?
There are a few things here. Remember, we have reported previously that UBS wants to keep more than 100 bankers out of Asia from Credit Suisse. But the real thing here, Dani, is there's a ton of overlap when you look at the investment banking base in Hong Kong in particular between UBS and Credit Suisse. So what are they going to be trying to keep? Perhaps more bankers outside of that Hong Kong region. Both banks have been tremendously strong in that region, very high-level underwriters in that region for high-flying tech companies. They obviously have very large wealth management presences in the country as well. But when you look at what UBS may look to keep, it's more along the lines of what you're seeing in India and Singapore. India is a place that they had wheedled down on their presence years ago, and the opportunity to bring Credit Suisse on expands their base across Asia, especially India being such a kind of robust area for capital markets as of late.
And on top of that, when you go to Asia, they're also then cutting costs there too and jobs there as well. But that's more on the Credit Suisse side, right?
Yeah, and that's where the overlap issue comes into play. The reality is UBS already has a lot of bankers in Hong Kong. And so while these job cuts are certainly unfortunate for the job market, one of the central theses for this merger is this idea that they can be more profitable at the end of the day because there's a lot of synergy. There is a lot of overlap that we've known they're going to have to get a handle on.
Okay, Sonali, thank you very much. That's Sonali Basak walking us through the Berkshire news and the banking news. All right, quickly, just want to mention we've been covering bond yields falling in Germany on the front end. Some more fuel to that. We just had a 9-month bill auction in Germany. It saw its highest demand since February of 2022. It's not just about the U.S. trade on Friday. A lot of it was about that in terms of the market moving to the short end, selling off duration. But Germany also changing, the Bundesbank changing how to deposits will be handled. You're not going to get interest payments off the back of that. It's really encouraging folks to not buy duration, to not hold their money with the Bundesbank, but instead to be buying short-term government bonds. So that's what we're seeing. Yields on the 2-year dropping about 2 basis points. Again, that strong demand for the 9-month bill auction in Germany. Okay, coming up, a look at some of the market-moving events that you need to know to get your week started. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Now let's get you set up for your week and your day. Here's a look at what's ahead. We're going to be getting German CPI and SoftBank earnings on Tuesday. Then CPI and PPI out of China. Will we see that disinflation coming through continuingly? And Disney earnings, those will be out on Wednesday. U.S. CPI, that's the big one, and jobless claims. Plus earnings from Alibaba are out on Thursday. And then we're going to be rounding out the week with U.S. PPI and UMich consumer sentiment. UK GDP, France and Spain CPI are all out on Friday. So a lot in terms of data. Plus, it's worth mentioning that the Treasury is going to be selling more than $103 billion in longer-term Treasury auctions this week. Kriti, this is what's going to kick off a quarter of higher auctions from the Treasury Department in what Fitch warned about, and a lot of people coming out and warning that the growing deficit is now something to be concerned about if you're trading in these markets.
Yeah, and at its core, of course, is going to be exactly what our previous guest, Jitesh Kumar over at Societe, was talking about, how much the market can actually digest this at a time when you're already seeing yields really jump this morning, Dani. I mean, I'm looking at a 2-year yield here that's already higher by 8 basis points. And again, is only about 6 a.m. New York time. Yeah. I do want to go from the bond market to the stock market, though, because there are a few stories there as well. Berkshire Hathaway, their Class B shares inching closer to their all-time high. This, of course, coming after their earnings story, higher by 1.5%. And we just had Sonali, Basak, our global Wall Street correspondent, walk us through those numbers. The cash hoard is significant, as is their insurance business. Now, if you're thinking about slowing down, a slowing economy, an insurance business isn't necessarily going to be thriving. And yet, here we are, seeing that pullback, and yet Berkshire Hathaway doing fairly well. But the weakness coming in those perhaps more economically sensitive areas, the railroads, the utilities, et cetera, nevertheless higher by 1.5%, Dani.
And I think it's remarkable because, as we're talking about with Sonali, it was just in May that they had their annual meeting in Omaha that Warren Buffett, was saying that, of course it was him, saying that the incredible period for the U.S. economy was drawing to an end. Now, perhaps he still believes that, and perhaps that's why things like railroads underperformed. But still, if you want a lesson in how to guide down this market, Buffett has done a great job of that.
Yeah, and I would say not just Buffett, but Charlie Munger as well, who, of course, has been by his side for ages and ages, also kind of beating that drum as well. Dani, I want to bring another stock to your attention. Monster Beverage in particular, MNST, seeing a lot of heavy volume this morning, which is interesting because it's really just on an analyst upgrade. Piper Sandler upgrading to overweight from neutrals, coming off their second quarter sales numbers. Despite that margin miss, nevertheless, you are seeing higher by 3.5%. Their price target being raised to $63 from $60. Let's zoom out, though, for a second, Dani, because this has been a theme among a lot of the beverage makers. You've seen it with Coca-Cola, even Pepsi.
I'm just still thinking about alcohol, not to drink alcohol, to be clear, but some of what we've heard in Europe. Yeah, it's too early for that. But in terms of what we've heard from the makers, a lot of spotty earnings. We saw Heineken do poorly, AB InBev do well. So for those consumer stocks, it's been a mixed picture.
Yeah, it's certainly something we're going to be keeping an eye on, especially when a lot of the dollar story is going to start feeding into essentially these multinational corporations around the world. Well, look, that does it for Early Edition. More stock coverage, more bond market coverage. So surveillance is ahead. Morgan Stanley's Michael Wilson joins the program at 8 a.m. Eastern this morning. Stick with us. This is Bloomberg.